So this is the Chapter 8 lecture entitled Receivables. And this is really a continuation of what we started in the last chapter, where we're going through the various balance sheet accounts. Last chapter, if you remember, we discussed cash. We also discussed a related topic, which was internal controls, as cash was the account that was most directly associated with requiring significant internal control procedures. In this chapter, we're going to talk about receivables, and first thing to note is that we do have a couple different types of receivables. First of all, we would have accounts receivable. Accounts receivable are really just the sale of goods or services on account. Would result in an account receivable from a customer. We would also have notes receivable, which would be typically longer term variety, usually over a 60-day time horizon. Oftentimes that would include amounts with interest that would be due. A good example of a note receivable would be, say you were a bank. We're talking about a bank or a financial institution that made a loan, a 5-year loan, 10-year, maybe even a 30-year mortgage. Those would be categorized as a note receivable. They would bear interest and be of a long-term nature. And we might have other receivables, such as interest receivable, taxes receivable. Could be a variety of other types of receivables. But in this chapter, we're really going to be looking at accounts receivable, specifically accounts receivable from customers. So we're really talking about the sale of goods and services on account. And those arise when we offer terms of payment terms. And typically we're offering 30 to 60 days without interest. So we're requiring that customers make those payments within 30 to 60 days, interest-free through that period. We might even offer a discount period where they would get a discount for early payment. And I don't think anyone would disagree that the key issue around accounts receivable is the ability to collect the receivables. So, I think maybe all of us at one time or another has had a late payment on the credit card account, or maybe even a loan that we have. And obviously that draws a lot of attention from the lender or from the credit card company. And that's obviously a key issue to them, and to anyone who's making sales of goods or services on account. They're going to want to make sure that they collect all of those receivables. But with any business of any size, it's unreasonable to expect that you're going to collect every single receivable. There's no way that a credit card company like Visa or MasterCard is going to collect every single account, every single dollar that's owed. So there's always going to be some amount of money that is not collectible. And the question is how to deal with that, and how to handle that, and how to treat that for accounting purposes. So really we're going to look at, in this chapter, we're going to be dealing with the issue of uncollectible accounts receivable. How are those going to be handled? So one method that we could use to deal with that is what we call the direct write-off method. And that is really simply writing off the accounts receivable at the time at which it's determined the account is not collectible. So at time it's determined that it's not collectible. And what we're going to do in that case is we're going to credit the accounts receivable. And let's say this is ABC Company. Let's say ABC Company owed us $1,000. And ABC Company went bankrupt. and we're not going to collect any of that $1,000. So obviously there would be a debit in the account right now, accounts receivable for ABC Company of $1,000. We're going to credit that accounts receivable to wipe it off the books. We're no longer going to receive it. And the debit is going to be to an expense account, which would reduce net income, would reduce our shareholders' equity, and that would effectively be a loss. So the account that we're going to use is what's called bad debt expense. So debit bad debt expense, credit accounts receivable, and that entry would be made at the time that the account is deemed uncollectible. All right, so that is pretty straightforward, and that would seem to work just fine from an accounting point of view. Debits equal credits. The accounts receivable is gone from the books. We're not going to collect it. And instead, we have an expense to recognize the fact that we've had a loss. And of course, that would offset the amount of the sales, and effectively it would be as if we've not had any sale at all. And so, of course, accounting-wise, that would work from a debit and credit point of view. The question is that the appropriate method to use? And so let's just think about, for a moment, this idea of offering terms. What is the reason that we're offering these terms of sale? In other words, why are we allowing people to pay 30 to 60 days later? And the reason that we're doing that is to generate revenue, right? So if we think about that, here we have some kind of revenue. And if you think about, how important that is, imagine walking into Walmart or into any store, and imagine if the store said, well, we don't take credit cards. You could imagine the amount of revenue that they would lose or forgo because they do not accept payment terms other than cash. So some small businesses require or accept only cash, and that's fine. But any business of any size would be at a huge competitive disadvantage if they did not offer terms. And so when we're talking about providing these terms of sale, we're doing it because we're really forced to, because all of our competitors are doing that. So revenue is really being generated by offering payment terms. And that's what gives rise to an accounts receivable. And so these payment terms are really critical to generating revenue. Okay, so without providing payment terms, we would have no revenue. The problem with the payment terms is that not everyone is going to pay. So we're going to have some uncollectible accounts receivable that result from offering terms. And basically what this is going to be is this is going to result in an expense. So the payment terms are necessary to generate the revenue, but they result in an expense. So if we think about this, the problem with the direct write-off method is that this entry here might come months or even years after the sale has taken place. And if we think about expenses and revenues, remember the definition of an expense is costs necessary to generate revenue. That's our definition of an expense. Therefore, this uncollectible account or this bad debt expense obviously fits that definition. This is directly related to this. The expense of uncollectible accounts is directly related to the revenue, because without the payment terms, we wouldn't have the revenue. And because of the payment terms, we're going to have people who are not going to pay their accounts. So this bad debt expense is a cost that's necessary to generate that revenue. Without these accounts receivable, we would not have the revenue. And therefore, without the expense of uncollectible accounts, we would not have revenue. So we now have expense that's directly linked to revenue, and whenever we have expense that's directly linked to revenue, we need to match the two together. So the key here is we need to match the expense with the revenue. The problem with the direct write-off method is that there is no matching. In other words, the revenue was recognized and in one period, and the bad debt expense is recognized in another period. And this could be, months or years later when the account finally goes bankrupt. That's when we're writing it off and recognizing the expense. The revenue was recognized many periods before, and therefore we have not matched the revenue with the associated expense. And we need to do that. So essentially what we need to do is when we have a sale or revenue, we're going to have to match that with our bad debt expense. In the same period. And that's what GAAP says we need to do. GAAP says we need to match, anytime we have a sale, we need to match it with a bad debt expense, because ultimately some of those sales, some of those receivables associated with those sales are not going to be collected. So we're going to come back and talk about the other method we're going to use to record the bad debt expense in the period in which we've generated the revenue.